Hi, this is Mateo, Mortgage Garcia. How's everyone doing today? I want to talk real quick about mortgage insurance and what mortgage insurance is. The simple definition is mortgage insurance is an insurance policy taken out to compensate investors or lenders due to a default of a mortgage loan. One thing to keep in mind is all loans have some sort of mortgage insurance if you are doing a loan above 80% of the home's value. For an FHA loan is basically a government insured loan. When someone takes out an FHA mortgage, they pay an upfront mortgage insurance premium that is financed into the loan. Additional to that, they pay a monthly mortgage insurance premium. And basically this insurance each month is paid to HUD or FHA in case the loan goes into default or goes into foreclosure. The lender can file a claim with HUD or FHA to compensate them for any losses that may have occurred. That's why on an FHA loan, lenders are willing to do a loan with a smaller amount down, or there's more flexible credit and income guidelines, because the lender's saying, hey, we'll go ahead and do this loan because the FHA is insuring our loan against any sort of losses. Obviously, for FHA to insure the loan, there's certain guidelines that the lender has to follow, which would be the FHA underwriting guidelines. With a VA loan is a loan made to qualified veterans, and typically VA just charges an upfront VA funding fee. This is a one-time fee that's financed into the loan, and this is basically an upfront fee that's paid to the VA for them to insure the lender's loan against any sort of losses. The upfront mortgage insurance varies a little bit based on how many times you've used your VA loan and some other qualifications. So even though VA is a zero down loan and there's no monthly mortgage insurance, there is an upfront VA funding fee. The other type of mortgage insurance is mortgage insurance for a conventional loan. A lot of people call this PMI or private mortgage insurance, because this is not a government agency insuring the loan. There's basically private mortgage insurance companies that are willing to insure a lender's loan against losses. Once again, if they follow the underwriting guidelines for a conventional loan, along with any of the guidelines for the mortgage insurance company. One thing to keep in mind on a conventional loan is the closer you are to an 80% loan to value, the cheaper the mortgage insurance is. The reason for that is the closer you are to an 80% loan, there's less risk associated for the mortgage insurance holder to pay out any losses in case there's a default or a foreclosure. The reason there is not mortgage insurance on a loan under 80% is that lenders feel there's no mortgage insurance needed, because in a case if a loan goes into foreclosure or there's a default and the lender has to sell this property, if there's 20% equity in the overall home, they're typically not going to have a loss, at least initially, on the overall mortgage. One thing to keep in mind is lenders are lenders. They want to make loans. They're not in the business to sell properties or make profits off of property sales. So they typically do not want a home to go into foreclosure. So this is one thing to keep in mind. If you have any questions regarding mortgage insurance or what your mortgage insurance options are, feel free to give me a call, 623-500-6041, or email me at mateosupremelending@gmail.com. Have a wonderful day.